Hello, everyone. Happy Friday. Welcome to another episode of the Tech Behind FinTech. Let's get some housekeeping things in order. I think the video is not as clear as it should be. So let me adjust that before we get started. 1 second. That should be clearer. I'm having some background issues, but bear with me and we'll figure it out together. I think I'm being cut off real quick. Let's see if this helps. I think that's slightly better, but no, I don't like that either. Was told last week, funny story, right? That my video I was blending into the background, and we don't want to repeat that same occurrence. So just bear with me while we just organize things slightly. Try to eliminate that. Okay, think it's something we'll just work on moving forward. Anyway, all right, let's get into it. My name is Nnamdi Osuagwu. I'm the host of the Tech Behind FinTech. Happy Friday. It is great to be back. We're going to get into some stories of the week and then regarding, financial stories, talking about really the technology aspects of it, some breaches that we found very interesting, and some blockchain stuff that we also saw. So we like to say that we talk about the technology that powers the money, the unspoken heroes in this game. So we are going live from Facebook, from LinkedIn, from YouTube, from Twitch. We're also going live from LinkedIn. That's a direct video on another device because they don't have integration with our platform that we use. All right, so look, let's get into it without further ado. Give me a post. Let me see how you guys are doing. Drop a comment in. I'm always curious. I also love the constant support. Some of you guys are weekly viewers, and we totally happy about that. You've been riding with us since day one. It's been 2 years now. So yeah, drop a comment. And like always, any questions, anything that you want to know that we discussed or want to dive into, definitely post a question, or even if you have some additional commentary, some insight, love to hear it. Okay, my guy just joined an Instagram. My guy, David Shanks, aka Trom Diggs. What's up, man? All right, so without further ado, let's jump into the first news article of the day. Let's add that to the screen. Let's do another housekeeping effort. Just our background. Okay. So this is interesting. The CFPB, which stands for the Consumer Financial Protection Bureau, they're currently investigating Goldman Sachs over credit card practices. The regulator is examining its credit card account management practices, including with respect to the application of refunds, crediting of non-conforming payments, billing error resolution, advertisements, and reporting to credit bureaus. So Goldman Sachs teamed up with Apple in 2019 to issue credit cards linked to iPhones. It also acquired General Motors credit card portfolio for a reported $2.5 billion in 2020. So they're based on these acquisition and partnerships, they're a major player in the credit card space. In July, the CFPB announced it had fined Bank of America $100 million for quote unquote botching the disbursement of state employment benefits at the height of the pandemic. In a separate order, the Office of the Comptroller of the Currency, OCC, also fined Bank of America $125 million for violations of laws and unsafe or unsound practices relating to the bank's administration of prepaid credit card program to distribute unemployment insurance and other public benefit payments. So, once this particular regulator is investigating you, the fines can be substantial, as we can see in the Bank of America case. So we'll see how it pans out for Goldman Sachs. Currently, they're under investigation, but nothing as of yet in terms of fines. Let's move on to the second article. Yeah, that's what's up. We got a comment from LinkedIn. I can't post Instagram. I can't post the Instagram comments on I can't post the comments on the screen, but I could just read them to you. What's the good word, champ? Keep showing up. Yes, every week we are being consistent with it. Appreciate that. And once again, on Instagram, if you want to have your comments posted and be part of the video, go to the techbehindfintech.com. We have links on our YouTube. We have links everywhere from YouTube to Facebook and LinkedIn, but you can also watch it live on the website and post your comments. All right, let's move on to the next article. All right, the Great Southern Bank selects Fiserv for core banking upgrade. So let's get an understanding, take a step back. Core banking is a system as a back-end system that processes daily banking transaction and posts updates to accounts and other financial records. Core banking systems typically include deposit, loan, and credit card processing capabilities with interfaces to general ledger systems and reporting tools. So all banks have some sort of core banking system in their background that they leverage. And a lot of, especially in certain spaces, we talked about this in a previous episode, that sometimes is very legacy. So they have a lot of legacy core banking systems. So it's lack of integration and so forth. So what this partnership with, they select Fiserv for an upgrade, part of the digital transformation effort. Let's read this. So Missouri's Greater Southern Bank has selected Fiserv and its DNA core processing platform as it looks to enhance its digital banking services and enable the integration of new offerings from fintechs. In addition to DNA, it is also selected digital banking, debit card, checking, and enterprise content management services from Fiserv. So let's read a comment from their from the bank. We chose DNA because it was essential that we had an operating system that could help us better understand our customers and adapt with us to meet our long-term business objective. Fiserv's DNA is a core account processing platform with an open architecture that makes it easier for financial institutions to integrate other solutions, bring products and services online quickly, and add new capabilities using the platform's own app and marketplace. Greater Southern Bank manages assets worth $5.6 billion, offering services to both consumer and commercial customers. It has 93 retail banking centers across 6 states in the U.S., along with a number of commercial loan offices. So yeah, I mean that's we've been talking about this. A lot of banks are partnering with the likes of Fiserv's, the Jack Henrys of the world and so forth, to enhance their core banking capabilities, just to be more. To just integrate better with modern technologies and leverage it. So it's all part of a digital transformation effort. Over the last few months, we've been posting articles with different banks doing this and so forth. All right, looking at Instagram. Okay, just have some more people that just joined. We just do a wave. Okay, let's go into the next article. All right, so this one is interesting. So let's just give some let's give the title. Let's give some background information. Title: Wall Street pros offer crypto holders a backdoor to bankruptcy exit. So what's been happening, right? With the likes of these DeFi platforms like Celsius and Voyager. We've been talking about them for the last last couple of months actually. So if you're not following it, at a certain point, they canceled all withdrawals from from customers who had funds deposited. I think for the likes of Celsius, that's about 300,000 customers were using it. Voyager, it looks like 3.5 million people were using it or have money deposited within their their platforms. Both companies later filed bankruptcy. So in the case, the people deposited, even though they weren't necessarily that turned from customers to now creditors in the bankruptcy. So what does that mean? Chances of them getting their coins back or their money, long road ahead. Would they get the maximum? Who knows, right? So all these are just question marks. The cases are still ongoing and they're in bankruptcy court. So you have businesses that popped up like Xclaim and Cherokee Acquisition that are essentially, they're open to work with certain customers so they can give up their rights to their particular coin and get paid now. So let's say hypothetically you had $100 deposited in Celsius or Voyager. With these particular bankruptcy claim businesses, what they're saying is, we'll give you $25 of that $100. I mean, sometimes it ranges. It could go anywhere from 10% to 90%, various factors. So essentially, they want to buy that from you, from the customer, and then the customer gets paid immediately, and they look out for the long-term gains. And now, if they're able to recoup close to the amount owed, then they make a profit. So, and they're backed by different hedge funds and institutional. So let's get into the article. Just want to give you that background before we jump into it of what's going on. So niche credit traders have a pitch for crypto holders locked out of their accounts at Voyager Digital and Celsius Network. Sell the rights of your coins at something like a 75% discount and let Wall Street worry about the rest. So when crypto lenders Voyager and Celsius went bankrupt last month, they turned their customers into creditors. Those users cannot touch their coins and don't know when they'll get repaid, how much they might recoup, or what forms the payouts will take. A quote from Cherokee: "Many creditors are still in a state of shock that Voyager and Celsius filed bankruptcy and they don't have access to their coins," said Vladimir Javelsovic, manager and founder of Cherokee Acquisition, a firm that brokers bankruptcy claims. "There's no real visibility about the value of their accounts will be or when distributions might be made, and many creditors simply want cash now." So Cherokee recently traded more than 1 million Celsius claims on $1 million worth of Celsius claims on Friday, as well as 3 others ranging from 10,000 to 73,000. The firm's website's claims market doesn't report prices for specific trades, but lists bids of about 25 cents on the dollar for Celsius transactions. Cherokee matches creditor with claim buyers, predominantly hedge funds, and sometimes holds the debts itself. Claims trading plays a role in almost every large bankruptcy. The market allows, for example, a failed retailer's clothing suppliers to offload their receivables to investors at a discount. The investors then slog through the insolvency proceedings in exchange for the prospect of a healthy return. The crypto bankruptcies are unusual because of who the platform's creditors are, overwhelmingly small individual account holders and the sheer number of them. Celsius had about 300,000 users with account balances of at least 100 as of July, while Voyager counts more than 3.5 million active users, according to court papers. So like I mentioned before and on the screen, you have Cherokee Acquisition. Xclaim, another online market for bankruptcy claims, saw about 500 Celsius and Voyager creditors sign up through its website as of Monday, according to Andrew Glantz, Director of Business Development and Legal Innovation. So purchase offers on Xclaim range from 10 cents to 90 cents on the dollar, depending on the nature of the debt and the platform it is tied to. Offers currently posted on the site were proposed by some of Xclaim registered buyers, which include 50 institutional investors. It looked real interesting. Let's go back to that screen. We're not finished. It's real interesting. I mean, that's the whole point, right? These guys file bankruptcy. Account holders, have their money tied in there and they can't get it out. So if you have Bitcoin, Ethereum, or Cardano, or Polygon, whatever coins you had, or even in some cases, they actually had money because the reason people made the deposits were the interest that they were getting was just, astronomical to what you can get in a bank. Like, for instance, last year for Celsius, it was like 18% you're making. So a lot of people, deposited their life savings in these platforms just because of that rate of return. And then, when the crypto market started to go down, they essentially got, a letter got put out or email, that withdrawals are being canceled because, if they withdrew all their funds, then it will create further instability in the platform. So they cancel withdrawals, and then later on they filed bankruptcy. So and what's interesting about it, those account holders got turned to creditors, which is a whole other issue. But all fine print when you're signing up for these types of services. In the fine print, it basically said that they have the right to do that. And when you transfer your coin to these platforms, it's no longer your coin. The company owns it, and you become, I guess, an investor or something like that. So really interesting. More people are joining on. Sammy, Al, thanks for joining. Appreciate you guys. Yeah. So that's essentially what's happening, and it's and with everything, with every scenario, you're going to have another company that creates a business opportunity from it. So if you're an account holder, you have the option now to go to Xclaim and Cherokee and get up to 25%, hopefully more, on $1 of your holdings. So obviously you're not going to get your full, with dealing with these companies, you're not going to get the full amount back that you're owed, but you get your cash now. And then they wait, as long as they have to wait for everything to play out, and hopefully, and then the goal for a Cherokee or an Xclaim is to get the maximum on that money owed, so they'll make the spread. But even in cases with them, they're still a middleman, because the article is saying, they're basically representing or institutional investors. When they say institutional, the like more, not individuals, but actual businesses or funds that buy these products because of the potential return. So, if we're just using share $100 and they paid an account holder $25, and later on they could recoup $75, that's a huge return, right? So that's the current situation. It's a quote. So funny. My college roommate, and we have some business ventures together, once said something. People were calling to buy some property we owned, and someone said, well, why don't you want to sell it? And he said, I don't want to sell it for the same reason you want to buy it. Always found that quote funny. Shout out to David Shanks for that quote. I have to give him that. I kind of I've used that same thing ever since. I love that quote. So let's move on to the next article. All right, so this one is really interesting. Let's get into it. Hold up and get my notes ready, queued up. Crypto criminals laundered $540 million using a service called RenBridge. So, just to give you an update, we're going to talk about this particular cross-chain bridge, and then we're going to get into how bridges are getting hacked. Spoiler alert in the last article, but it's very, very interesting. So, blockchain analytics provider Elliptic said that the decentralized cross-chain bridges provide an unregulated alternative to exchanges for transferring value between blockchains. So what does that even mean, right? Essentially, if you have coins on one blockchain like Ethereum, you can these bridges allow you to transfer it to another chain like Solana and or something else and get value there. So that's what these cross bridges. But what the criminals in this particular case are using it for is to launder money. So sometimes you have these attacks in which they get hundreds of millions of coins because the whole point of the blockchain, right? And especially the public ones, it's transparent, so you can actually see what's going on the chain itself. So if you breach something and then you got some type of funds from that, a few million, right? And then you start transferring, people could see it. So one of the cross, for the most part, that's where the cross chain bridges come in. So they're basically using it to hide where they got the illegal money from, or illegal coins from, and so they can basically get away with the tokens. And they were able to launder like $500 million with this on this particular platform. So let's talk about it. For the most part, cross-chain bridges or blockchain bridges are used for legitimate purposes, enabling users to move cryptocurrencies seamlessly across blockchain networks. Users typically deposit their tokens from one chain to the bridge protocol, which is locked into a contract, and then the users issue the equivalent or parallel token in another chain. Elliptic noted these bridges have also been used by ransomware gangs, exploiters, and hackers to launder proceeds of crime. Most recently, at least 2.4 million in crypto assets stolen during the Nomad attack August 2nd. So that was like about a week and a half ago, went through a cross-chain bridge. The Conti ransomware group, which famously attacked the Costa Rican government back in June, has also laundered 53 million through RenBridge. Hold up, let's the next article. So a couple of things happened. 80 million stolen from Liquid Global Exchange last year, allegedly by North Korea. They were allegedly laundered through RenBridge. 267.2 million worth of assets from DeFi services were laundered through RenBridge, and the 53 million from the attack on the Costa Rican government. And I remember we talked about that last year, that attack. Let's get into some more stuff. So it's really, really interesting how they're using it. And now, let me just see if there's any questions going on. Okay, no questions. All right, we're going to get into now this whole cross-bridging stuff. So in one aspect, right, so you understand, like these cross-chain bridges are holding billions of assets. So, you know, in one respect, it's being used to launder like money being received from cyber attacks and so forth from, you know, other chains. In this next article, which I find interesting, the actual bridges have been attacked themselves because they're holding so much funds that they're open for attack because, you know, people want that. So hackers have stolen on the other end, from laundering the money to now stealing money on the bridges. Hackers have stolen 1.4 billion this year, 2022, from crypto bridges. And we're going to go into why it's happening. So January 18th, let's just get the screen bigger right here. January 18th, multi-chain, 3 million. January 17th, Qubit, this crypto bridge, got breached for 80 million. Wormhole, February 2nd, got breached for 320 million. Meter, February 5th, 4.4 million. Ronin got breached for 615 million, March 29th. I remember that. We told that was huge. That's like the biggest one so far. Harmony Horizon, 100 million, June 23rd. Most recently, 200 million Nomad. So I think I got the numbers wrong in the previous article. All right, let's go back. So let's get into this whole thing. So like we said before, crypto bridges link blockchains network together, and they've become a major target for cyber criminals. Talked about these articles back to back because in one aspect, I find it fascinating, it's being used to launder money. Another aspect is actually being attacked. The bridge we talked about before so far has not been compromised, RenBridge, but some other bridges have been. So a total around 1.4 billion has been lost to breaches on cross-chain bridges this year. The biggest incident, like I said, the Ronin with 615 million. There's also 320 million stolen from Wormhole, a crypto bridge backed by Wall Street high-frequency trading firm Jump Trading. Let's get into it. Blockchain bridges have become low-hanging fruit for cyber criminals with billions of dollars worth of crypto assets locked within them, said Thomas Robinson, co-founder and chief scientist at blockchain analytics firm Elliptic. So how bridges work. So, like we said, like a bridge is basically a piece of software that allows someone to send tokens out from one blockchain network and receive them in a separate chain. as blockchains are distributed ledger systems that underpin various cryptocurrencies. When swapping a token from one chain to another, as in sending some Ether or Ethereum to a Solana network, an investor deposits the tokens into a smart contract, a piece of code on the blockchain that enables agreements to execute anatomically without human intervention. Hold on, let's get my notes together. The crypto then gets minted on a new blockchain in the form of a so-called wrapped token, which represents a claim on the original Ether coins. The token then can be traded on a new network. That can be useful for investors using Ethereum, which has become notorious for sudden spikes in fees and longer wait times when the network is busy. So why are they under attack? So, in the 1930s and late 20s, there was a bank robber named Willie Sutton, aka Willie the Actor Sutton. And when he got caught, I guess a reporter asked him, why are you robbing banks? And he said, this is a famous quote, because that's where the money is. Same concept with these bridges. They hold billions of dollars, and they are pretty vulnerable because of certain engineering practices that the way they're built is not as secure as they should be for the amount of money that they hold. So they're being attacked. Similar to banks in the 1930s, it looked like a lot of bank robberies. Well, more so, and security measures, I guess, since have been taking over the course of time. But let's get into it. So the vulnerable bridges can be traced to sloppy engineering. The hack on the Harmony Horizon Bridge, for example, was possible because of the limited number of validators that were required for approving transactions. Hackers only needed to compromise 2 out of a total 5 accounts to obtain the passwords necessary for withdrawing funds. So limited amount of validators, and they compromised only less than half of them, and they were able to get the funds. A similar search situation occurred with Ronin. That was a $615 million hack. Hackers only needed to convince 5 out of the 9 validators on the network to hand over their private keys to gain access to crypto locked inside the system. In Nomad's case, the bridge was much simpler for hackers to manipulate. Hackers were able to enter any value into the system and then withdraw funds. Even if there weren't enough assets deposited in the bridge, they didn't need any programming skills, and their exploits led to copycats to pile in, leading to the 8th largest crypto theft of all time. So, from a security aspect, this is what we always talk about, right? All this stuff is software at the end of the day. And, we have to kind of start, we have to look at application security. These smart contracts and these networks, it's not, how do I say this? It's not like, okay, the traditional software we've been doing since the 90s and before. It's new. So, you have to figure out new ways to test it. And we had shows on this in the past episodes, and it's good to bring up. We talked about smart contracts extensively, and it's a different method that you have to go about securing, and you get one shot at it, essentially. It's just, these things have to be thought through. It's cool to reference some other shows. We kind of actually got into smart contract securities. One really some good episodes on that. If you look at our past episodes, I should have brought some links over to reference it. All right, so that's the high level why they're being attacked. And in general, let's go into like why bridges are important, because the whole concept is like, why use them anyway, right? And bridges are an essential tool for decentralized finance. The exchanges of money are managed by a programmable piece of code called a smart contract, like we just said. This contract is written on a public blockchain, such as Ethereum or Solana. It then executes when certain conditions are met, negating the need for a central intermediary. As the DeFi space continues to evolve, developers will need to make blockchains interoperable to ensure that assets and data can flow smoothly between networks. Hence, why we need these bridges. Without them, assets are locked on native chains. But the problem is these bridges are effectively ungoverned, said David Carlisle, head of regulatory affairs at Elliptic. They're very vulnerable to hacks or to being used in crimes like money laundering, which we just said. One major question is whether bridges will become subject to regulation, since they act a lot like crypto exchanges, which are already regulated. This week, the U.S. Treasury Department's Office of Foreign Assets Control, or OFAC, announced sanctions against Tornado Cash, a popular cryptocurrency mixer, banning Americans from using the service. Mixers are tools that blend a user's tokens with a pool of other funds to conceal the identities of individuals and entities involved. That's interesting. Prior to this article, I didn't know what a mixer was, so that's good info. Yeah, I mean this was the last article of the show. Found the whole these crypto bridges very interesting in being breached. Currently, as the article mentioned, they're not being regulated, and they're not as most of these are not as secure. So they're being breached left and right. Yet billions are being held on it. So as always, very interesting stuff. Oh, what's up, Jamil? We wave to you. Got a couple people joining on Instagram. Have to have you back on my show. Actually, that was a good one. I hope your book is out, because we said we have to do a repeat earlier this year. So let's circle back on that. I'm going to reach out to you, have you back on as a guest. Yeah. So really interesting stuff. That actually is the last article of the show. As always, I thank everybody for joining in on the episode. The show is sponsored by Strategic Generation, providing cybersecurity consulting services around SOC 2 compliance for FinTech, and also information security programs and things of that nature. I'm gonna wait and see if there's any comments or questions before we log off. Checking Instagram on the side. I'm also checking this particular comment list. Okay, I don't see any comments. As always, listen, thanks for tuning in. Have a great weekend. Make it spectacular and have a great day. I'm going to log off. Cheers.